Avalanche, or the AVAX token, might be one of those hidden gems. Of course, it's a blockchain that has been around for quite a while. There have been quite a few successful meme coins on there as well. For example, Coq.ino. The question is, will adoption continue to grow? Does it make sense to buy AVAX right now? To answer this question, we are going to look at on-chain data. We're going to look at the data most people are not considering. We're trying to figure out what the potential upside from here actually is. Now here's a chart most people look at, and I don't think it's that useful. It is just AVAX in US dollars. The problem is that first of all, this is on a linear scale. So we don't really know what the percentage changes are. This little change over here is 300%. This big change over here is only 150%. So it's better to look at logarithmic charts. This now shows us how much percent something moves. If something moves to the same delta vertically, then the same percent is gained or lost. But there's another problem with this chart, because crypto is highly correlated with one another. So when Bitcoin is going up, most altcoins go up as well. When Bitcoin is going down, most altcoins go down as well. But the reason why we get into an altcoin is to get more performance than just buying and selling Bitcoin. Because with altcoins, we take on more risk, and that additional risk should get compensated. And so here we've got Avalanche relative to Ethereum. Now, isn't that interesting? There seems to be some kind of a resistance, and there seems to be an increasing floor. And we might potentially bottom at one of those floors. Now here's Avalanche relative to Bitcoin. There was an initial hype around the chain, and so it outperformed BTC by more than 400%. But since December of 2021, it underperformed, and that's by 91%. Here's the AVAX dominance. So how much of all of crypto is currently in AVAX? And again, from its peak, it tended to go down by 77%. Maybe we are in a sideways trading range, and maybe we have found a bottom. But first, let's try to answer why Avalanche actually performed that much worse compared to Bitcoin. Why did we see this massive decline? And the answer is tokenomics. Have a look at how many new AVAX tokens got issued over time. We started out with 45 million AVAX, and this grew to almost 500 million today. So more than a 10x in the supply. Now, if the demand doesn't grow by 10x, of course the price has to go down, at least relatively to Bitcoin. Now this chart might be shocking for a lot of people, but this is actually a silver lining, because while the token stays inflationary, relatively speaking, that inflation isn't that bad anymore. It looks like nothing is changing, right, in linear unlock schedule. However, we have to look at this relatively speaking, right? When the supply increases by 10x, that's a problem. But now we are at 500 million and the peak is at 720 million. And that's 5 years from now. So a 50% inflation over 5 years, 10% per annum. It's not great, but it's far away from the crushing numbers of a 10x within a few years in the past. Avalanche is now the 9th largest blockchain in terms of its total value locked. It's currently got 1.5 billion worth of capital. Now there have been 2 rallies in decentralized finance. There was the DeFi summer and there was the recent recovery. This is now the total value locked across all chains. And DeFi summer happened in 2021, DeFi winter in 2022, and now in 2024 and 2025 we see our recovery. The market as a whole has not yet seen the all-time highs. How about Avalanche? How is that recovering? Here's the answer. This is the total value locked of AVAX over time. The DeFi summer was great for Avalanche, then came the decline, but unfortunately the recovery doesn't bring it near its prior heights. We used to have a total value locked or capital in AVAX of 11.5 billion with a B. Now we are at 1.5 billion. But there are some things that are stabilizing. Literally, this is the stable coins on Avalanche over time. Yes, this also peaked with DeFi summer, but it didn't decline as much. It's 50% lower to its all-time high, and it seems to not shrink anymore. Here's the decentralized exchange trading volume. Again, not as high compared to the heights of 2022, but the picture looks much better compared to the total value locked. So now there is less capital on Avalanche, but the DEX volume hasn't changed that much. That means that the capital that's currently deployed on the chain tends to generate higher returns. Because this is how DeFi works, right? People deploy their capital, say in liquidity pools, and then traders trade in and out via swapping. Now the swapping activity generates trading fees, and the trading fees go to the capital providers. If there is now much less capital in the chain, but there's still relatively high trading volume, the capital that's deployed in the chain tends to make more returns. Have a look at this. This is the perpetual futures trading volume of Avalanche. That's suddenly skyrocketing. It's much higher compared to 2022. This seems to be the story of this bull run. There's all kinds of perpetual futures market that are currently crushing it. Leading is the Hyperliquid protocol. I really like Hyperliquid, by the way, but I will talk about this in another video. Here is the bridged total value locked. So how much capital is moving into AVAX? Unfortunately, this chart isn't that long in duration, but at least in the last few months, we tend to see some inflows into the chain. Here's the number of addresses, and again, we see how recently things are becoming active again. The problem with the Avalanche chain is that there's nothing unique about it. There are no killer apps. There's nothing like pump.fun on the Solana chain where a lot of meme coins get launched. There's nothing like the virtual protocol on the base chain where there's a lot of AI agents. There's nothing really unique about Avalanche. The largest protocol on the chain is Aave, and unfortunately Aave is available everywhere on 17 chains to be more specific. I also have my doubts about the rebranding of the largest decentralized exchange on Avalanche. It used to be called Trader Joe, now it's called Let's Fucking Joe. LFJ, that's the new design. And my impression is that the team simply tried to get some traffic from pump.fun, from the degen crowd, and that's why they made it that casual. But really, this place in the market is already occupied by Solana. Avalanche cannot compete there. Yes, there are a bunch of meme coins on Avalanche, but they don't get traded as actively compared to Solana, for example. It makes sense because the gas fees on Avalanche are much higher than on Solana, so active trading is more expensive. So the trading volume in the last 24 hours on Avalanche was $114 million. And that compares to $3.7 billion on Solana. So that's more than 30 times the activity. Yes, the chain has constant usage. Here's the number of ERC20 token transfers over time. But really, growth is currently happening elsewhere. Avalanche is in red and Arbitrum is attracting a lot of stablecoins. And that's again because of Hyperliquid, because of perpetual futures trading. This is currently where the market is getting most hyped. AVAX might be a great deal when the price is low. Is it now low? It's debatable. Relative to Ethereum, potentially. Relative to the entire market, not necessarily. Yes, as an addition to a portfolio, it might make sense to put some money in, but as a main position, I think the action currently is somewhere else. Now here's something very important to understand. Crypto is highly correlated, as in when the market tends to go down, everything goes down at the same time. There's very little variation. This is true for the bear case, but it's also true for the bull case, as in most things go up at the same time. There seems to be not so much benefit in diversification, as in it seems to not really matter what kind of token we buy. If we have 5 tokens or we've got 20 tokens, the portfolio tends to move in the same direction anyway. Now the reason for those synchronized ups and downs in the market cannot just be money flows, because the money is flowing in and out of the overall space relatively consistently with little volatility. What we've got over here is the stablecoin market cap. And since October of 2023, we tend to go up over time. So there is money getting into the system. People deposit their fiat currency, say on a centralized exchange. The centralized exchange then sends it over to a stablecoin custodian. The custodian holds the funds in a bank account and then mints the stablecoins on the chain. And we can see that minting, but also the redemption on this chart. So the volatility that all prices go up or all prices go down, it's not caused by money flowing in and out of the system as a whole. Instead, I believe it's caused by the swapping activity. So people going risk on or going risk off. So it's not the market as a whole expanding or contracting, it's the participants within the market that swap. And we can see that swapping activity with much more volatility here. So this is now the stablecoin dominance. We're not looking at the stablecoin market cap, we're looking at the stablecoin dominance. How much of all of crypto is in stables? And in the last 1.5 years, this tended to move in a range between 9% and 5%. And now compare that stablecoin dominance with the Bitcoin price. When the stablecoin dominance is low, it means the Bitcoin price tends to be high. When the stablecoin dominance is high, it means the Bitcoin price tends to be low. So there is somewhat of an inverse correlation. When people deploy their stablecoins, or when they're swapping from risk off to risk on, when stablecoin dominance goes down, prices tend to go up. And so because of that overall effect of market synchronization, because of the high correlation, things move in the same direction at the same time, it's not a good idea to just look at US dollar prices in order to make a good decision whether or not to buy or sell an altcoin. Because charts like this are also influenced by the overall market swapping activity, not just by the swapping activity within the altcoin. So for example, this here, right? This is Dogecoin. And who would have thought that Dogecoin already peaks at 46 cents when in the past it peaked at 56, 57 cents? Who would have already anticipated the peak earlier? How could we figure that out? Here is how we can figure that out. This is Dogecoin's dominance. And here those two tops align very nicely. And so a dominance chart is simply a chart that looks at the current market cap of an altcoin relative to all of crypto. So that way we remove the ups and downs of Bitcoin or of Ethereum. We are just looking at the relative performance of the altcoin versus the rest of the market. And again, that tends to trade in ranges. And that's how we can find out how the second peak should actually happen earlier in US dollars, because the dominance was already at historical heights. But check out this, right? This is Shiba Inu in US dollars. But here's Shiba Inu's dominance. So we do have a quiet, constant trend. Over time, Shiba Inu tends to underperform the rest of the market, and when we are high on the trading range, it might make sense to bet on falling prices. When we are low, we could potentially buy, but of course it's always somewhat risky to buy low when the overall trend is also bearish. So I personally prefer, when there's a declining trend, to look for short opportunities, so to bet on falling prices when we are high, and when we are in an upwards trend, to buy the dips. So when we are in a bull market, we buy the dips. When we are in a bear market, we short the top. And so Shiba Inu underperforms the market over the long term. So instead of trying to fish for bottoms here, isn't it better to just wait for the next short squeeze, to wait for the next rally in the price, to then bet on falling prices? Then the time is also on our side. Even if we see a bit of a spike above the regular trading range, we can just wait it out, because the overall trend is in our favor. That's not necessarily true when we buy, right? When we buy low in a declining trend, we might not find the exit on time and then have to sell again, potentially lower. Another example, here's Chainlink. And what we see over here, that's Chainlink's dominance. So just according to this chart, it might make sense to potentially buy some Link over just Bitcoin or Ethereum. Historically, it's rather cheap. Now, there are two central reasons why I like those relative valuation charts and those dominance charts. The first one is that we can actually see what happens specifically with that token, completely independent of the overall market. But the second reason is by plotting relative valuation charts, so say cryptocurrency A versus cryptocurrency B, we tend to see less volatility. We tend to see the trends clearer. For example, over here, this is the Ethereum price in US dollars since February of 2021. There's no clear trend. It's not necessarily easy to figure out when to buy or when to sell. But then we've got here Ethereum relative to Balancer. I like to look at this chart because it gives us two nice points. First of all, the overall volatility is rather small, but secondly, the gains are also extremely consistent. So this is an outperformance of 5,400%. This is how much Ethereum outperformed Balancer. And again, relatively speaking, with not that much volatility. Getting that much performance in a such consistent manner without having to time the market actively, That's quite unique, right? This is a risk to reward that we can only get with relative valuation plays. We can't get this just by buying something in US dollars. And again, the reason why everything in US dollars fluctuates so much is because the market as a whole goes risk on and risk off all the time. And that creates massive additional volatility. But we can get rid of that volatility. We can actually make money by buying this. Now, we don't just buy this, we have to set up a long Ethereum and a short balancer position. So to get this performance, we have to do a bit of quote unquote financial trickery. But yeah, why do we see such consistent outperformance? The reason is that balancer over time tends to have an expanding token supply. And a lot of that additional supply goes to liquidity mining. So to a lot of people that just get continued allocation to the token that then sell it off over time. And so this then differentiates the winners from the losers long term. The people that are willing to take one step further, they're going to look not just at the next 100x meme coin, it's likely going to go to zero, but that actually figure out what are the dynamics within the market and how can we profit from those dynamics. Those people tend to do better than just the people that buy and hold Bitcoin, for example. I have made dedicated tutorial videos on the topic. First of all, how do we even plot those relative valuation charts? How can we look at them? There's an entire tutorial section just on how to use TradingView in a proper manner and seeing the things that most people don't, right? Most people just look at things like this. This is not giving us any edge. But then there are also videos on how to actually execute those trades. How can we gain from relative valuations? How can we set this up? How can we continually make money with comparatively little risk? Now, most people here on YouTube are not willing to share their own performance, but I'm okay with doing that. I'm okay to share how much money I'm making on average over buying and holding Bitcoin. Because this is again where the big differentiator is. Everybody can get Bitcoin's performance, but actually the art in this is to make more than Bitcoin. If we take the time to trade actively, we have to outperform the benchmark. Now here are the monthly returns that I have made over buying and holding Bitcoin. So every data point is a month. This dotted line here is the 12-month moving average. And when we average out all of those dots, the monthly alpha over buying and holding Bitcoin for me is 2.1%. Now that might not sound like much, but that compounds over time. And then especially if we also add more money in the portfolio over time, we dollar cost average in, we have a quite nice smooth growth curve. So here's my active portfolio with trading and dollar cost averaging. And I hope that over the next 2 to 2.5 years, I'll be able again to double that portfolio. If we of course use leverage, we can make much more on a single trade. But I'm super cautious. I take very small bets. For example, have a look at this. I'm sharing my own trades. This is in the Gerhard Trade channel, and I opened again, based on relative valuations, a short of the Donald Trump meme coin. Trump relative to Solana was quite high, and it started to come down. And then our members also entered. They also had some leverage in there, so this was some gains. I waited a bit longer, closed this then at 141%. But because I only use 1 or 2% of my entire portfolio on a trade like this, the average alpha per month is only 2.1%. But if you're willing to take on more risk, you can of course grow much faster. Actually, our members do exactly that. So here's the channel, share your wins with some leverage and proper market timing and still reasonable risk management. There are several 100% in single trades easily possible. And so I think it's very important to forget about price targets, as in can Ethereum hit $4,000 or can Dogecoin hit $1, etc. Those kind of things don't really matter. What really matters is the relative performance. Capital within crypto moves from asset to asset. Attention moves from asset to asset. So there is all of the capital in the space. Sometimes it is risk on, sometimes it is risk off. But what really matters is where is the capital flowing to and where is it going away. And then all we need to do is to trade the relative valuation. It's much easier to make money that way. Again, would you rather hold this or would you rather hold this? And so yeah, feel free to check it out. It's currently $125 per month. You are locking in that rate. So when we come back to the 165 again in a few months, then you will still continue paying the 125. Whatever you're paying now, you will continue to pay. I will not increase the rate for everybody that's signing up now. If it's your first time here, feel free to subscribe. I publish this regularly. A like would be very much appreciated as well. It helps the channel grow. See you next time on YouTube, or see you in premium. There should be also somewhere a pop-up here on the right where you can click directly. It will lead you to the website. So see you over there. Cheers.